Hi, our topic today is about the accounting equation, okay? Now, accounting equation. This is the accounting equation. Assets equal to liabilities plus owner equity. Alternatively, you can also write assets equal to owner equity plus liabilities, okay? It's the same. Okay, now, I believe you still remember from our past lesson, we talk about assets, right? So assets are the resources owned by a business, okay? Owned is a keyword, owned by a business. So assets equal to liabilities plus owner equity. So these are examples of assets, okay? We can have cash, bank, land, building, equipment, stock, vehicles, and debtors, okay? We have already talked about debtors, so I'm not going to explain again. And liabilities. So liabilities are the rights of creditors which represent the debts of the business, okay? So we can think of liability as what the business owes, okay? Or we can think of it as a business debts. So what are some examples of liabilities? For example, loan, bank loan, and creditors, okay? Someone who you owe the money to, creditors, okay? And lastly, owner equity, we have also talked about this. So owner equity is the rights of the owners. So for examples, we can also say that equity is the owner claim of company asset. So example of owner equity is, for example, like owner investment, when the owner bring in money or assets into the business. And what do we call this? We called it the capital, okay? And then we can also have revenue. Revenue will increase the owner equity. And drawings. Do you still remember what's drawings? Okay, so drawings is the withdrawal of the probably the goods or the assets from the business for your own personal use, okay? Is called drawing, okay? Withdrawal from the business for your own use is called drawing. So this one will reduce the owner equity, and we can have also expenses. So all these four items will affect the owner equity, okay? And now for additional capital that the owner bring into the business as well as revenue, it will increase the owner equity. And as for the withdrawal from the business for your own use and expenses, it will reduce the owner equity, okay? Equity here, it means owner equity, okay? So this is the accounting equation again. Assets equal to liabilities plus owner equity, okay? This equation must always be balanced, okay? It must always hold true no matter what transaction have taken place, okay? After every transaction, it has to be balanced, okay? So for example, assets is 100, and over this side, it has to be 100, okay? It must always be balanced. Assets equal to owner equity plus liability. So if this is 50, over here it should be 50, okay? They must be balanced. So this is one of the most important point of it. So the accounting equation shows that everything owned by the business, which is what we call the assets, is financed by the external sources, okay? Which we call the liabilities or the owner equity, okay? So this is how it looks like again. Assets equal owner equity plus liabilities, okay? So assets, for example, like your cash at the bank or your cash in hand, your motor vehicle, the office equipment, and your liabilities are the bank loan maybe. Equity is what the owner bring into the business, okay? So how do we interpret this? You see here, the accounting equation show that everything owned by the business, the asset, is financed or is contributed by the external sources or the owner equity. Take for example, like you see the motor vehicles, right? This is the assets of the business. Now, where does this motor vehicle comes from? okay, is either bring into the business, okay, by the owner himself, okay, in the form of capital, or it can be if the owner do not have enough money to afford the motor vehicle, it can be part of the bank loan, okay. This motor vehicle can be bring into the business by borrowing a bank loan, okay. That's why we can see all the assets are contributed or are financed by the owner equity and the liabilities, okay. Now if this is more difficult to comprehend, maybe you can think of it like this, okay, just like yourself, okay. You have a mobile phone, you have a pocket money, okay. Where does all this comes from, okay? You do not get all this by yourself, right? Because you're not working yet. So all the things that you have, that you own, is contributed by your parents, okay. They give it to you. So maybe you can think of it like this. So all the assets owned by the business, okay, for example like the car, the office equipment, cash and all that, okay, is either financed by the owner who brings in to the business, or either by the liabilities. For example, the car is by the bank loan, okay, and so on, is financed by the bank loan and so on, okay. So what the business own is equivalent to what it owe, okay. So the resources of the business is equivalent to the sources of where the resources come from, okay. What you own, okay, the resources is what you own, or from where, okay, these resources comes from, or from where these resources are being financed, okay, by the owner or by the external liabilities, okay. So now we can actually work around the accounting equation. So you see, assets equal to liability plus owner equity. So if they ask you to look for the accounting equation starting from the liability, how do you find it? Okay, how do you work around the accounting equation? So you have liability here, this is plus. So if we want to look for this, we move this over the plus, we move over to the asset side, then it will become minus. So it will be assets minus owner equity. So liability move over, become minus, so it will be asset. So minus owner equity. Liability will be asset minus owner equity. Now you tell me, how about owner equity? How should the equation looks like? Owner equity equal to? Yes, correct. Owner equity equal to assets minus liability. Okay. So owner equity equal to asset minus liability. Okay, now just to recap again, the very important essence of this accounting equation is that the accounting equation must remain in balance after each transaction. Meaning to say, if we have 100 here, over this side, they have to be 100, okay? So now let's take a look at some example. Say for example, the assets increased by 1,000. So on this side, there should be a 1,000 increase. If it's not increase in liability 1,000, there should be an increase in the owner equity of 1,000, okay? Similarly, if a asset reduced by 1,000, there should be a reduction in liability of 1,000. If it's not here, then it should be here, okay? A reduction of 1,000. And next, if it's not involving the liability or owner equity, so if asset increased by 1,000, then it could be asset reduced by 1,000, okay? So this one will be 0, and here will be 0, okay? So the effect of the transaction is more detailed, okay? So we'll go through this next time, okay? So this is just the very basic first about the accounting equation. Okay, so that's all for the lesson today. Thank you.